dark pool trading has been discussed a lot on Reddit, on Superstonk, and quite widely. And it's been a difficult concept for me to get my head around. But essentially, now you can correct me if this is a wrong understanding of it, is just another exchange that is less visible and a way for hedge funds to make their activity maybe not unknown, but just not as obvious to the market as a whole. And I think you mentioned in your AMA that it's got to something like 40% of all trades made in the market today are done through dark pools, and now that seems like a lot. How have we got to that point where almost half of the trades are taking place off market, and how has that sort of been able to remain such a secret up until now?
Second part of the sentence, it is secret. When you do something that's secret, it may mean you're covering up something that's crooked, which is often what happens in this case. Now, the U.S. trades are supposed to be cleared through the Depository Trust and Clearing Corporation, the DTCC. Its subsidiary, the DTC, which is the Depository Trust Company, is the vault for all shares, and they are digitally assigned to the major broker-dealers for their clients. So when the client of one major broker buys something and client of another one sells something, the digital entitlement is moved by computer. Now, the NSCC, which is the National Securities Clearing Corporation, is supposed to settle the trades, which means moving the digital entitlements between the buyers and sellers brokers. However, since the 1990s, dark pools have enhanced the system of X-clearing. X-clearing is avoiding going through the DTCC. It could be done easily with a very big brokers such as Goldman or Morgan Stanley, because they have so many clients that they may have one client buying something and the other client wanting to sell something, and they can just do the settlement just inside. They never have to go to the DTCC. X-clearing means clearing outside the normal clearing process. Now, dark pools was an enhancement of that. They are markets run by private firms or banks, prime brokers. They trade outside the stock exchanges, and they're hidden from most investors. They're not exchanges, but they are exchanges. They're internal crossing, X-clearing, moving the stocks away from going through the exchanges, which are public. And they're used by clients such as hedge funds to buy and sell large blocks of shares in anonymity. The idea was, we don't want to move the public price of a stock on an exchange because there'll be copycatting, because maybe they need to buy, a buyer needs to buy a huge amount and can't get it all from one source. So the broker will buy part of it, and if it's on the exchange that's open, everybody will see this huge amount has just been bought. Therefore, other people are going to buy it. Therefore, the stock price will go up. And so the big guy who wants to buy the rest of the shares is going to pay more. So that was the reason for the dark pools. The large traders could act secretly. They wouldn't inform the trading public that they're looking to buy or sell some shares. And the trades were confidential. In theory, neither side knew the party on the other side. Now, the dark pool operators knew both sides. And if they were trading on their own account, they could use that information. And so that's what officially dark pools were about. Now, 40% of shares go X-clearing. Most of them, it's hard really to tell, because everything is so secret, but most of them seems to be through the dark pools, and they don't go through the DTCC. So the prime brokers move them between their own clients or through companies they own, because the big prime brokers, they own the dark pools. And so it's not some unlit building where people exchange shares. I'll give you this, you give me that, and they wear they have secret handshakes. It's all done by computer, but it evades the DTCC. So
well, that's the point.
They evade the more stringent post-trade reporting. It's hard for regulators to look at specific trades. So a lot of the trades go below the radar. They may be netting a lot, never reporting at all. That means I sold this much and I bought this much, therefore there's zero. They don't report anything. Zero is net. It's netted to zero. So if you put the dark pools with the financial company broker-dealers ex-clearing, it really increases the possibility for concealing illegal trading activities and market manipulation. Why are they secret? The prime brokers want it that way. It's a way to do scam trading without being called to account. Except now, how did this get out of jail card free get written into the SEC rules? And the key scam trading they do is through naked shorting, because the SEC Reg Show for short, the regulation on naked short selling, went into effect in 2005. It applies only to shares that settle through the DTCC. The Reg Show kept saying, the SEC kept saying, because ex-clearing is so rare. So if a company's trades fail because the shorts were never covered, they don't fail if they weren't sent to the DTCC. So the dark pools that bypass the DTCC means there's no way for the DTCC to know if trades were really completed, if shares were delivered, if shares are processed ex-clearing. They would only be known to the trading parties. It's an extra layer of secrecy, because this is very helpful. I said before that the vault, the DTC, has in its records the entitlements, the shares of each prime broker that the prime broker is keeping for its clients. Well, we have found out in comparing claimed shares to shares in the DTC, there's a huge amount of shares that really don't exist. That's why they can't be in the DTC, because you can only have real shares where you got a real entitlement, and the dark pools will cover up the fact that a lot of the shares being moved around are counterfeit. That's why there's overvoting. That's why companies like Taser, the stun gun company, found they had a vote where they had 60,000 shares. There were 60 million shares. There were 80 million votes. Those 80 million shares cannot be in the DTC because they're not real shares. So they stay in the dark pools. They're a license to naked short, which means a license to steal. And the buyers don't know about this. The other thing they lose is they have digital entitlements from their broker. But if you don't have real shares, you can't get the cheaper capital gains tax rates, and you cannot vote. But the brokers don't tell their clients that. Very often they even send them proxies, but then they don't file them with the company or with the proxy handler because they won't be accepted. But they don't want their clients to know. And what they do is they send the clients payments which are called in lieu of dividends. Probably if you got a check or you got an announcement, you got this money, you don't think about it. It's because in lieu of dividends, they're not entitled to real dividends because they don't have real shares. Now, to get back to GameStop, the dark pools played a role in the GameStop manipulation. 25% of the GME float is traded over the counter compared to less than 1% for major stocks. Compare that. 25% compared to 1%. Why would they do that? The total GME volume traded off exchange skyrocketed in January. There was a spike in dark pool trades, especially the last week when the short squeeze was on, and then it was shut down. The big investors who trade in dark pools increased their volume till that week when the price dropped. And in February, over 500% of the float, and this is amazing, it could be like that, was traded off exchange in dark pools. Massive repeat high frequency trades is one of the ways that happens. You know, if you're doing a high frequency trade, you are not borrowing or locating a share. It happens in nanoseconds. Then the GameStop over the counter, OTC over the counter, which means all of the things that don't go through the DTCC, the volume as a percentage of the float was over 200 times higher than the average volume as a percentage of the float for Dow stocks. And each time they took another measure. For instance, the average over-the-counter trading for Dow 30 in February was 2.8% as a percentage of float, and it was 234% for GameStop. So you know something very crooked is happening there. The other thing that happened that was really interesting with GameStop is the average trade size was always very large. That was the purpose of the dark pools. Well, when they got into the manipulation, the average size decreased to less than 50 shares per trade. What major hedge fund is buying shares at 50 shares per trade? And it went down as far as 1 share per trade. So this was meant to, through high frequency trading, to manipulate the market. And that is what has happened with dark pools. They're another mechanism to manipulate and cheat.
Now, Lucy, one of the things I absolutely love about you and about watching your interviews and your AMAs is your fearlessness to just say what you believe and what you see. There's not many journalists would go as far as to call a lot of what you've said there a license to steal. But,
it is.
Yeah, it is. I'm not saying you're wrong. I'm truly admiring your willingness to come out and say it because, the veiled language that.
Well, the reason mainstream journalists don't say these things for a number of reasons. One is their sources are the people that I'm talking about, and so they can't call somebody a crook. They can write if there has been an SEC or Justice Department enforcement, they can do a story about that. They won't follow it up much, but they'll say this happened. This company was fined and full stop. But they're not going to go after the continued corruption because those are their sources. They depend on them for their daily and weekly articles. Some of them, and we know this from some cases that were brought in Overstock, some of them are bought off. Some of them are paid. People have testified that they give money to certain journalists. They're paid. Some of them are just lazy or stupid. Sorry. It takes a lot of work to do this. It's so much easier to rewrite a press release, which I think is what most of them do. So if you're lazy or stupid and you don't want to make waves, you don't talk about these things. It's only because of the massive spike in the market with GameStop that anybody is even talking about this, even though some of the tactics have been used for years.
Thanks so much for listening. If you enjoyed the show, please subscribe, follow me on Twitter, or sign up to our mailing list. Thanks a lot to our sponsor, ExpressVPN, the #1 most trusted VPN. Get lightning fast connectivity with servers in 160 locations across 94 countries. Keep your browsing privacy safe with ExpressVPN and get a 35% discount on 12 months of ExpressVPN when you follow the link in the description below. Don't forget my book is now out and available to order on Amazon and on bookshop.org. That's Brexit, the Establishment Civil War. And most importantly, thanks for listening. We'll see you next time.